Hello, warriors. Good afternoon, good morning, good evening, everyone on planet Earth. How's everyone doing? Hi, Rich. Okay, we've extended our offer 10 hours. You won't see this tomorrow. We've had a great response. Thank you, everyone. Hi, Brock. Nice to meet you. Ziggy's from Mars. Okay, let's talk about what happened that was pretty important yesterday. In the S&Ps, if you recall, and I know a lot of you people are regulars, so you were here Friday when I was talking about a 2-week reversal that would take place in the S&Ps if we closed under the prior 2-week close, which was 2988.5, and we accomplished that by, where did we close? 2970. We also have a monthly off number that we're already underneath, which is 2972 for October. You know what was interesting is I don't know if CNBC was right, but they said that yesterday in one day, we wiped out all the gains from last quarter in the market. So, mainly because we've been sideways in this huge megaphone or rising wedge. So anyway, the weekly signal, it might be something you guys want to think about. If you could count to 2, you could do it. You start on the current candle and just count back 2. And they're pretty good numbers to trade off of. For example, this week's off number was, get rid of this down here. This closed 30.0140. And yesterday's high, didn't even get close, 92. Okay, so we never even got back to this week's off number. All right, so here's the point. When you look at the daily, this was a breakout of an ascending triangle right here. See this? So we took out Volgi's 2960 with authority. We're negating this. I'm not saying we can't bounce, but now old support should become new resistance up around 29.35 or 40. And a continuation move is going to take us to this channel, about 28.80. And breaking down under this level, I believe is going to take us back to the June low and clean out every last bull. Although I'm sure there's, tons of stops. They're starting to be elected, but the panic low would be down here. Everyone with me on that? Just give me a why. If you kind of understand the technical narrative I've laid out in S&Ps. Yeah? Okay. So we start closing back above, say, 29.40. Maybe something else is happening, but we'll see. If that happens, we could end up being in just, a real fear move here. Okay, Monica. I did want to touch upon the gold, which, benefited from yesterday's fear, but keep an eye on it here. So this was the throwover line. See how it held it. We even got that big bounce last week. So this is what the line was based on, was a big throwover and acceleration, and now we're trading back underneath it. So if gold could get back over 1490, it has a chance to do something to the upside, maybe correct this decline. But I wouldn't get carried away because it might just be a breakdown and just a rally back towards the breakdown. Okay, so and it's going to continue. It could continue if the yen continues. So yesterday I felt early being short the yen from the 815 level, and we had a pretty negative day To me, it looked, in fact, look how off numbers come into play. You see today's low is 49. 2-week off number in the yen is 56. So, we're testing it right here, the 2-week off number on Wednesday. But if this continues to the downside with risk off, 107 is possible. And then perhaps this neckline of whatever you wanted to call this formation takes you down into the low 106s. But the S&Ps look much more vulnerable to me than the yen. Okay, and the Dixie was at a top in Dixie. So far, so good. So we'll see. Could we still stretch up into the upper 99s on, everyone's looking for a weak number Friday? What if we come in tough? So that's a possibility. And if we are going to get continued risk off, this is starting to look like a little bit too much of a extension here for this to be a right shoulder in the yuan. My vote is still a new high for a third drive, and I can't see the market liking US dollar yuan making a new high. So that's my intro to the team. Okay, I hope that we're adding value to what you're trying to accomplish here, Warriors. And I'll bring Blake on now and see what Blake has to say. Maybe Blake could tell me why the Swiss, even though the dollar didn't recover much, why the Swiss is up so sharply today. I know he knows.
No, I don't know. It's I would say it's the Swiss National Bank. If I had to throw a guess at it.
It was weird when I opened my platform and dollar's steady and Swiss. If you didn't cover shorts, it's in your face.
Yeah, sorry, it's.
Did you guys take it?
Yep.
Nice.
And then took it off at 99.35, maybe somewhere around there.
Yeah, I know how you hate those carrying charges. So maybe it's good to have carrying charges when you're short Swiss because you don't marry it and you take what it gives you.
Yeah, when I got up this morning, I was a little shocked. I was like, man, I cannot believe the dollar Swiss was. I felt the same way. I was like, are my quotes wrong? Am I looking at things wrong? But
yeah, because Twitter went crazy. I can't use TweetDeck. Who knows?
It's not just you. It's a global outage. Yeah.
Is your TweetDeck working? You're here in the U.S.
No, my TweetDeck's not working. I just told you it's a global outage. It
well,
hasn't worked
I
since
know, but
last night.
Stelios says his TweetDeck is working.
Mine as well.
Oh, really?
Mine as well.
See,
when I woke up, it had logged me out, which never happened. So there was obviously some issue affecting, Europe as well. But I managed to log in and haven't had a problem since.
Yeah, US is down. I know mine's down. Like one of the.
I needed a break anyway.
One of the things is I have Bloomberg. So when you use Bloomberg, I have like a TweetDeck type of tool in Bloomberg, so it's kind of bypasses. I'd rather use TweetDeck just because it's it has
get used to it.
I'm used to it, and yeah, it's easier for me because I already have all my lists set up. I had to set up another list on Bloomberg so I could. I
thought maybe the administration, some of Trump's allies, shut it down so he couldn't hurt himself on Twitter.
No, I don't think that's the case.
You know me, I'm a conspiracy guy.
Always. Yeah. Well, hey, in just about 5 minutes, we're gonna have ADP numbers. So let's real quick. Let's take a look. So yeah, the Swissy has rallied quite substantially. We're coming up to pretty key resistance up here. This is, and the whole reason why I shorted it yesterday, and you guys remember, I shorted at 1.0014, which. We're almost back at that price again, but it's 127% extension of this last down move, and then the 618 of this other move, and it was great. The ISM numbers came in really poor, so it just fell out of bed, and of course here we are again, up at these levels. It's like, okay, well, I sold a little bit this morning, but my stops are pretty close. If I give back a little bit from yesterday, it's not a big thing, because I actually, for lack of better terms, I crushed it on the dollar Swiss last night, or I say last night, yesterday. And I know a lot of people in our chat room were, a lot of people were trading it. So, in our room. So that was awesome. Now, as far as, what do we do here? Well, I'm looking at the euro. We have like this inverted head and shoulder pattern setting up. So that's something to pay attention to. Now, key resistance, if you guys don't recall, this is where we failed. This is going to be the 109, 109.65 level, and that level is really key for a lot of reasons. Because when we traded down here on, I think it was Friday or Thursday of last week, where we traded down here and then we rallied. Everybody was calling a triple bottom, right? You take the lows from, low, triple bottom. It was natural that they were going to get stopped out. They got stopped out pretty good. But in order for us to really get a bullish move together, we have to see the euro back above, well, first of all, this like neckline of this inverted head and shoulder pattern, but I believe that 109.65 is really critical here. So we'll see if we'll see if we can actually manage that today. And again, this now has to do with ADP numbers, which are coming out shortly, and then also ISM services, which will be tomorrow, and then NFP, which will be on Friday. So I mean, the fact of the matter is if you're man, look at this Swissy just ripping right up towards highs here. Look at that, just on fire. Man, Swiss National Bank is really
purely a Euro Swiss move. If you look at them, I mean, the whole move has come from Euro Swiss.
Yeah, Euro Swiss is definitely on the move here. So I don't know where it is. Why is it not on my screen? Somebody must have removed it. But yeah, I mean, it's Euro Swiss is blasting higher here. And this is and it's all Swiss National Bank is just powering this move higher. So just keep that in mind. But we have the euro, which we'll be watching going into ADP. And then let's take the dollar yen. So the dollar yen got hit really hard. In order for the dollar yen to continue higher here, we're going to have to see or bounce here. We're going to have to see some decent ADP numbers. Obviously, it's critical coming in here in the next few minutes. Actually, in the next 2 minutes. So let's watch the numbers. And this is Bloomberg, so you guys can see what the ADP numbers we're looking for. Looking for 140,000. Previous was 195. Look at revisions as well. My 2 cents is the numbers are going to come in probably a little bit light here, but that's that'll be we'll see if it does come in a little light based on what we saw on the manufacturing numbers. And then if, like I said, if what I'm thinking is going to come to fruition, we're going to start seeing a little bit weaker economic data in the US moving forward. So we'll see here in just a moment. So we have about a minute. So let me push this over really quick. Dollar Swiss just tried to push out some stops above those highs, so be careful with that. It's not really what I want to keep up. Here's the dollar yen. The dollar yen is going to be the mover, though, for today. And remember, this has been really under pressure here, the dollar yen, and we're not seeing, any type of recovery. So let's see if we can continue this move lower. The dollar yen setting up a nice double top too from the failure yesterday. So that's something to also think about. Cable's coming off a little bit as we rallied towards 123. We're coming off, and here, watch the numbers here. Watch the revision number right after the headline comes out. Oops. 135. So it's in line. It's not horrible. Watch the revision. Dollar yen's coming off. Let's look for the revision. 157, so it revised lower too.
Weaker.
Yeah, another lower revision. So let's see if the dollar yen will, I mean, we're not getting much of a reaction. We got a little push lower. Actually, what I'm more curious about is I'm more curious to see if the euro will actually make that push above 109.35. That'll be a little bit more of a telltale sign here if we can get that move above 135. That'll tell us that a little bit more dollar weakness is coming in. Euro looks a little firmer. Let's see. Aussie's still weak. Kiwi still weak. Swissy made that move above the highest. Nice, just stopped out everybody and reversed. That's always pretty. I still have mine, but it's just a little piece anyway, so I'm not really too worried about it. Yeah, so what I'd like to do is I'd like to see this, back below 99.90, and I'd be happier with that. I might add to it if it drops below that. But what I'd have to see is also I have to see the euro dollar come above this trend line, because that means this inverted head and shoulder pattern is trying to play out. So and I guess that's what I'm looking at right now. A couple other things really quick before I pass it over to Steve, and I think Stelios will be popping on probably in the next 15 minutes or so. Today is the last day of our offer. We had to extend it for a couple of days. We had a few requests of people wanting to, they're just trying to get their finances in order. They wanted to, take advantage of the annual plan. I get it too, because it's a difference between if you're going to be with us for you're going to be with us for the next year, why not do the annual plan, because it's such a good offer. So a lot of people are like, hey, can you just hold up for a couple of days? So we did, but this is the last day. It actually expires today. And if you don't know what ForexAnalytix does, let me just explain a couple of things to you. First and foremost, this is our platform. And our platform, let me move the data flash. Data flash also releases the data that you would have saw in ADP. It comes out almost as fast as Bloomberg. It's a really nice feature that Steve added to our platform over this last 6 months or so. But what you see here is analysis from several different types of analysis. So when you have like a currency pair, and obviously right now is not a great example of this because we've had such choppy markets. But you look at the S&P, macro is neutral, Elliott wave is neutral, candlestick, basic technical analysis, harmonic analysis is all red or bearish. That might tell you, hey, I need to start looking at the S&P and seeing if there's any bearish setups. And then from there, you can go into the analysis and go, okay, well, what's the analysis here? Oh, well, we closed below 29.40. So, because we broke below 29.40 support, it may signal we're moving back to the 200-day moving average, and then you're like, okay, well, now I'm going to start looking for entries, that type of thing. But what ForexAnalytix does is allows you to see, multiple types of analysis on 30 some odd instruments. Plus, on top of that, you have, your support and resistance levels. When those are hit, you get, an alert to your desktop. If you have them set up, we already preset them with them. But you get alert to your desktop. You get alerts to everything else. Hold on one second, will you please, guys?
Just want to note to everyone, gold came off that line I showed earlier at the 1490 level.
Yeah, gold is retesting
the throwover line.
The neckline of that head and shoulders formation we were talking about. Go ahead, Blake.
Yeah, I had somebody from the office asking me a question. What I was saying here is like the support and resistance levels, when they get tripped, then you get alerts to your desktop or your mobile device or what have you. We have a lot of different features that are just it's designed to allow you to have as many tools as possible on one platform this way you don't have to search all over the place for, but like let's say you're using Twitter, so this is, you can set up Twitter, and I know some of you might be using TweetDeck and you're like, oh my gosh, my TweetDeck is down. Well, our Twitter function here works great, where you can add your you can add all of your the handles that you want on Twitter, and then you have your feed. You can just add the accounts here, and then you have your feed on ForexAnalytix, where you have your Twitter feed right here instead of TweetDeck. So Dale, for example, you said, well, my TweetDeck's down. Well, just use ForexAnalytix, and then on top of that, we have our chat room, and our chat room, I would say, is probably
Forex too.
I would say our chat room is probably our our mainstay. It's where we have 80, 90, 100 traders in there throughout the course of the day. We have 94 of us in there right now, chatting around and talking about markets, and it's cool because you can not do that. Let's go over to you can look at all the charts that we've been posting throughout the morning. This is all from this morning. You go, oh, what did oh, what's that image here? Oh, here's their, Benedict's talking about the peso, and Paulie put up his bias chart. And that's all, it's all from this morning. And then you can see just the normal comments that we're all chatting around, and everybody's, goofing off right now because they know they're on the webinar. So, so anyway, it's, it's a really great place for, those of us that trade from home. We trade from our offices, and we're on remote locations, and we want interaction with people that are like-minded, that are just no BS. We're just talking about the markets. So anyway, it's a great place. Hopefully you guys join in. Remember, the seasonal offer, it does expire today. It will be removed after today, and then we'll go back to our normal pricing. So if you haven't taken advantage of it, make sure you do so. Make sure you download the mobile app. With that being said, I've got to tend to a few things at my office right now. Steve, good morning.
Good morning, Blaker.
How's it going?
Good, mate. How have you been?
Good. Just just trying to make sense of the market here. The dollar's now pushing higher. We got the euro breaking lower. Not too sure why, for whatever reason. And because that was a weaker number, weaker revisions. I guess maybe the ADP number was close to inline, so maybe it's just not as weak as people were expecting. But ISM, I guess we're going to have to wait for tomorrow. I was hoping that we might get a move above this 109.35 level, and it just at least it's not happening now. It might happen a little bit later. I'm hoping it does, because I just want some volatility. I'm sick of this low volatility environment.
I'm 100% with you, and I really can't decipher very well the dollar move myself as well, in the following sense. I mean, we see clear signs of the US economy slowing. At the same time, we know that slowing US economy will definitely produce more monetary policy action from the Fed. That shouldn't be a dollar positive. So I'm not very sure. Obviously the dollar is always getting a bid when we get risk-off moves, but I don't think that's the place to be at the moment. And as you've said, I don't think there is any risk reward here. I mean, we've seen this slow drift lower, for example, in the Euro USD. But are there risks to the downside from here? In all honesty, I doubt it.
Well, as far as the dollar goes, I know the Pavlov, behavioral response to risk off is, oh, I got to buy the dollar. I just don't know if that's really going to be the case this time around. I look at, and this is, I think I'm probably one of the only people that feel this way, that if this market really does go into risk off, I do believe that actually the dollar is going to weaken this time around, and it's mostly due to positions that are extreme. And when you get position unwinding and everybody goes back to cash means different things to different people. When I say people go back to cash, I'm really more along the lines of people saying, put me back at zero, whatever position I've been in. So one of the bigger positions that's in the market is, short euros, buy everything else. I'm talking currencies specifically, short euros, buy everything else, because you're using the euro as a funding currency. And, if I'm, getting zero interest on the euro, and I'm buying dollars because, the Fed's paying me, more than zero, then, if I have to unwind that, it's going to unwind anything that's major, that's a major positioning in the market, and get us back to square. So that's why that I believe if we do have some risk off, that I think the euro is actually going to strengthen before it weakens again. So that's why I look at the euro in a in this bearish wedge, and I still think the ultimate move in the euro is going to be, let me see this. It's going to be this. It's going to be a move higher. Not saying that's happening today. I'm just saying that eventually it's a move higher, then a move lower. And I think it's the one that catches the market most off guard, and I think that's the move that will catch the market most off guard. So that's why I'm
you're not the only
skeptical.
one that thinks that.
Well, I don't know who else thinks that.
I've been reading a lot of people think that could happen.
Yeah, and I think that's, and I don't pay attention to what everybody else is thinking. So but that's my and you talk to so many people, throughout the course of your, just interviewing everybody. But that's my base case to risk off, because I do think that the market's going to come down, and I do think that stocks are going to come down, whether it's post next week. Next week's a big week, guys, because next week we have obviously the China-US trade negotiations, and even if there is a truce or there is some sort of deal, the market's already priced that in. So we might get an initial bump in equities, but people are going to take a step back and say, well, the global economy is slowing. U.S. economy is slowing. We have structural, growth issues, and whatever rally that we see in equities is going to be sold. So how far we go or how high we go in equities, if there is some sort of quote unquote deal, will depend on the structure of the deal versus, there's a deal or no deal. It's not a TV show. It's going to be, what kind of deal is there, if there is. If there's no deal, then the S&P will be trading down here at 2,500 really fast, and so that all comes to head next week, and that's why I think getting too aggressive between now and not next weekend, like a week from Saturday, is and I would say a week from Saturday because next Thursday and Friday are as far as we know right now, that's when the high level China trade negotiations are. We should know by a week from Saturday where we stand. And like I said, if there's a deal, S&P may be higher, but I only believe marginally, because one of the things I wanted to mention, do we have more data coming out? I guess we do. No, not this morning. Okay, so let me. Okay, hey Stelios, good morning. Let me talk about one more thing that I have. I should talk about really quick before I let you guys go. Yesterday, you guys might know Ian Shepherdson from Pathanon Economics. He's on CNBC and Bloomberg quite a bit. Probably one of the best British economists I've followed over the years. And we subscribe to their service. I say we, my firm in Connecticut that I work for, that I trade for, we get their analysis. And he was doing like a bit of a roadshow the last 10 days. He's been in New York, and so he came to our office because we pay a lot of money to get his analysis in my inbox, if you will. And he came to our office, and I was on a conference call, even though I live in Scottsdale, Arizona. I was on the conference call with him and listening to. There's a few takeaways that I have here, because I'm not going to rehash the entire hour that we spent with him. First and foremost, as far as China, their view is, he called it the Trump blink. Do we get a Trump blink next week? And he made a good point that he goes, when Donald Trump is put into a corner, he tends to double down. He doesn't tend to back off, which is very true. So the question is, next week, do we get a double down, if you will, or we're gonna basically continue on with our tariffs and maybe even increase them or whatever, or does he blink and say let's call this a truce and let's start from scratch, let's renegotiate. And the only reason why there might be a quote unquote Trump blink is because like I pointed out the last couple of days and maybe over the week ahead video, is that the impeachment process is hurting him, not because I believe he's going to be removed from office, which I don't think is going to be the case, but I think that the negativity is going to weigh on his reelection prospects. So that's a factor for him. So he wants to get a deal put on the table. And then the second part of that is, is China, being as prideful as they are, will they just say, what, screw you, we're going to just wait this out and, and let you, burn, and we'll just deal with the next administration as they come in. So, it's a very tricky situation going into the next week. And then also, my other takeaway was regarding Brexit. We're talking to probably one of the best British economists around, and probably one of the better economists in the world. And his thoughts were, it's a complete mess and it's a complete disaster, and it's very hard to decipher exactly what's happening and what is going to happen. And my thoughts were, wow, if this guy lives in London and he's obviously very up to speed on, he gave us a bunch of timelines on what may or may not happen, but he's like, it's all very confusing. And if he feels that way, how are we as traders around the globe supposed to make rational decisions regarding the pound? Especially when, you're dealing with a Boris Johnson. And that to me was a really clear indication that I really shouldn't be trading the cable right now. and it's funny because yesterday there was a headline that came out that pushed the pound up 100 pips. I actually traded that headline because he was actually talking about Brexit when that headline came out, this headline, and I actually made some really good money scalping long, and then I scalped it short going the other direction, and I made some good money going both directions in the cable, surprisingly, because really I have no clue. I was just buying based on momentum and selling based on momentum. But as far as trying to establish a position for me, it doesn't make any sense. And I can honestly 100% tell you personally, I won't be taking a position in the cable until I have a clear indication of, is there going to be a hard Brexit or a soft Brexit? So, until there's like news where I can say, definitively, I feel that something is or is not happening, I'm not doing it. And that was the big takeaway for me yesterday, is like, wow, here's one of the top economists in the world, UK, let alone the world. And he's like, it's very confusing, and I hope you guys take that to heart, because it's, I'm telling you that because this is, it was so impactful to me. So anyway, and it was really quite, if you don't know who Ian Shepherdson is, this is him right here. This guy, this bloke, You'd see him, on CNBC. He's just really awesome. He was just on Bloomberg Markets a couple of days ago. He's just really, really awesome guy. We've had the opportunity to meet with him on conference calls before in the past, where we're all conferenced in and ask him questions. But he came to the office and spent an hour with us, and it was cool. So anyway, that's that. And I wanted to pass all that information along to you guys because I thought it was important. And I'm going to pass it on to Steve Stelios. It's all yours, guys.
Good morning.
Good morning, Blicker.
Thank you,
All
Blake.
right, guys. Hey, have a great one.
Thanks, you too.
You too, mate.
Okay, so just a couple of things I want to mention. First, we didn't talk about this on yesterday's webinar because the numbers came out later. We had the US ISM manufacturing PMI. Actually, I didn't hear what Blake said for the first 20 minutes. I was out, but it was a horrible number. And obviously the S&P sold off on the back of that. This is in line with most European economies. PMIs are really dropping down a cliff, and it's a very bad leading indicator. So this is something that's definitely going to weigh on stocks. Now we have to remember that its earnings releases start next week, I think, and it's also the buyback blackout period. So, for people
which usually is a bad omen when we have a buyback black period.
Because what's been driving the rally for the past years. Yeah,
exactly. I mean, it's a huge part of the rallies, companies buying back their stocks. Yes,
issuing debt at low interest and buying back the stocks. We've said this so many times on this webinar. So that's just something to keep in mind. And I personally think this move probably has more legs to go, because with all these leading indicators turning lower, earnings are probably going to miss. As a whole, I mean. So just something to be wary of. And the other thing I want to talk about is the UK. Again, I don't know what Blake talked about, but the UK Prime Minister Boris Johnson said he's going to give a proposal to the Europeans, which, if I read somewhere correctly, it was something to do with 2 borders and 4 years. So it's all about the Irish border still.
And Stelio, I don't know if you read that. By the way, this is one of the tools we offer here, Ransquack News. As you see, 38 minutes ago, German government spokesperson says he will examine the UK's proposal, and the EU Commission will do everything possible for a Brexit deal as time is pressing. Though we are prepared for everything. That's the last statement we had.
And Boris Johnson has said again today that the EU have to compromise, just like the UK will compromise on their side. Otherwise, it's no deal. End of story. And he's repeated that they're leaving on the 31st of October. So it's all hotting up now, and you can see.
Isn't he, though, bound after what they voted to not go through a no-deal Brexit? I mean, how exactly does this work from a legal perspective?
I actually don't know the mechanics and the legal aspect of that. But yes, you're right. There was a vote that effectively blocked the no-deal Brexit. But if there is no deal and the date comes and there's no extension agreed, because remember, we have to have unanimous acceptance of 20.
Yeah, from all
states.
20. Yeah.
So 20, what happens then? By default, you go into a no-deal. By default, you leave and you have no deal in place. So even though they voted for this, it doesn't mean it can't happen. So,
of course it can. Yeah. But I mean, theoretically speaking, it can happen. Theoretically, again speaking, it can happen just because he decides to do so. I mean, theoretically speaking, because of course he can, decide to, ignore that, or to follow, tactics that might inevitably lead to that.
Yes.
Who knows? I really hope that they do something at the 31st. I don't think that this situation can go on for much longer. I mean,
I don't think so. And it's hurting the economy for sure, UK economy a lot. And, Boris Johnson said a no-deal scenario is not something he's seeking, but it's an outcome for which they are ready. So he's talking the talk. And
let's see if he can walk the walk.
Exactly. So, so apart from that, Okay, you covered ADP, I think. We had the weak construction PMI in the UK, again, in line with all the PMIs turning lower globally, not just in the UK. The UK obviously has the extra hurdle of Brexit, but globally it's not looking very good, is it?
No, it isn't looking at all good, and it's really funny, Stelio, seeing stocks with so many signs. I mean, first of all, there is nobody that can read data that won't straightforward acknowledge that at the very least, we are at a global slowdown of growth. Now, adding to the mix, how mature this business cycle is, and that's the third or fourth slowdown we have during this cycle. I mean, the chances of this leading to a recession are high. Seeing that stocks ignore all signs of economic slowdown, all signs and potential outcomes of geopolitical and political risks. I mean, what market is pricing at the moment to make sense having to do with risk assets, it's nuts, if you ask me, completely nuts. That doesn't mean that stocks can't move higher, but what I'm trying to say is that at some point we're going to look back and everybody will realize that valuations where they currently are, pricing in rainbows and unicorns are, purely crazy. As everybody, looks back now and acknowledges that, of course, in 1999 and 2000, we had like a huge stock bubble in the Nasdaq, for example. So, it's a matter of make sure, if you're a long-term investor, make sure that you're not the last man standing when the music stops, because there are not enough chairs for everybody. That's the only certain thing.
Absolutely, yes. Okay, that's it for me.
Okay, anything else before we go to charts?
No, just want to wish everybody a good day.
You do, mate.
Thanks.
Thank you very much. Okay, let me start by the obvious, and then I'm going to go through questions. So the very obvious is I kept talking and waiting for a breakdown from 2960 in the S&P. I mean, I've been talking about that level for a couple of weeks, and we got that yesterday. We finally got the daily close below 2960. And as I told you yesterday again, if that were to happen, my next downside target is this ascending trend lines. This ascending trend line supports area, which is currently, it's passing from like 2890. And below there, that's a totally different game. So, first key area broken. Now we have the second one at 2890. I'm pretty certain that a break below that level will lead to a much, much bigger decline. I see no reason why we can't even come down and retest like 23.38, if that's the case. Because look at this. This is an ascending wedge, right? But one step at a time. For the time being, now in the short term, I maintain a bearish bias as long as we keep closing below 2960, because, as it almost always happens, a key area of support will become a key area of resistance once broken, and vice versa, okay? So 2960, in my opinion, is now a key area of resistance, and as long as we keep closing below it, that will mean that the path to least resistance in the short term remains lower. Of course, if we bounce from 2890, that's a different story, because keep in mind that we're still, theoretically speaking, in an uptrend, right? Higher lows, so there's no question about it. But it's going to be a huge technical development breaking below 2890, and I do think, especially with all the factors that Stelios mentioned, for example, earnings coming in the spotlight, the blackdown in buyback period, all of those can play a significant role in seeing stocks unfold from here. Okay, so it remains to be seen what's going to happen in the short term. As I said, you have no reason not to be bearish. I think we're probably going to make it to 2890. Now, if you have a look at the DAX also got a beautiful rejection. You can even, talk about a triple top there, even triggered like that triple top formation once it sliced through this previous low. And as you see, we finally made it. I was looking to make it, the previous time we were pushing lower last week to the level of support I was looking for, that 12,060, call it roughly. Okay, so we're currently testing that support area. Now, that doesn't mean that we're going to hold here, but I think that for the day, we might stop here because this is an area of support that has some significance. So for the day, we might be done moving lower in the DAX. If that proves not to be the case, that's going to be a very bearish signal. If in essence this level, has no, produces no bullish reaction even in the short term. Now, having to do with gold, obviously with what was happening yesterday, both gold and the bonds caught a bid. Just one comment here with gold. If this is a head and shoulders formation, I mean, if the market wants to play out this head and shoulders formation, keep a close eye to the area that gold is currently retesting, right? Because in essence, we are back testing this head and shoulders neckline as a resistance in this case. So if you want to be bearish gold, this is the place you want to be short. Because you have an excellent risk reward ratio, and if we get rejected from here, from this retest, then we can move lower until we actually fulfill the target, which is at 14.14. If on the other hand we break higher from here, then this is a totally different thing we're talking about. This was purely like an ABC type of a corrective move, and we're headed to new highs. That is why I said, watch this previous neckline, because now we're going to find out if that was actually a head and shoulders formation, because if it is, it needs to, the neckline needs to hold now that it's being tested as the resistance. So you like to the short side, this is the place you want to be short. But if we break higher, be careful, because we might have seen the end of a corrective move. And if that's the case, I think we should be finding ourselves quite fast in, sorry, this has been moved. Okay, there we go. We should be finding ourselves quite fast in the 61, in the long term, 61.8% fib at 1586. Okay, so that's to cover the question with gold. Now, USD yen, obviously, in response to what happened with bonds yesterday, got rejected after retesting the previous high. Keep in mind, though, that it still remains above this descending channel. So very nice rejection, very nice outside black candle yesterday. So quite a nice daily reversal. Nice continuation so far today. You should pay attention to 107. 107 is going to be quite significant. If we hold 107, fine, but if we break below 107, we trigger a double top formation, which would point down to 105.50. Okay, so back to this area, simply because, as you see, this is a 150 pip range. So subtract that from like 106.94, whatever it is, that should roughly bring us to 105.40 or whatever, which is exactly this horizontal support resistance area. So 107, quite key for us to find out what's happening here with the USD yen. And as I said, of course, the benchmark bonds yesterday. Also, here are the treasuries. Treasuries, continued their rebound high. Keep in mind, though, we're currently testing the 61.8. So I still think that this move higher can prove to be corrective. Yesterday's fake intraday move, because at some point yesterday we were trading quite lower. I mean, it was a very, very ugly looking candle, and then we reversed and we left behind an outside hammer in essence. So far today, we haven't managed to push much higher, and keep in mind, as I said, we've stalled at the 61.8. So I'm really looking to see if the Treasury's rebound is going to stall here. Obviously, if we see this continuation of risk off, there is a high chance that the Treasuries might even continue higher. Although, as I've said, this move higher still doesn't really inspire me like a continuation of the trend. I would still, from a technical perspective, purely here in the Treasuries, would want to see another leg to the downside. Now, crude, which we know that it is quite sensitive to what's happening with risk. Yesterday, at some point, was quite much lower. And then it closed, leaving behind quite a large spinning top, which is an indecision candle. Today, we have an inside candle to that candle. We seem to have stalled at this area, 78.6 previous lows as well. But I have to say, despite stalling here, the fact that we had that huge news-driven spike higher, which it was almost 20% higher, right? Which has been completely retraced, is quite a bad omen for the bulls. So I don't know if we're going to see some type of a bullish reaction from here in the short term, but I have to tell you that my appetite of being of looking for long positions here has definitely waned. So I've switched to neutral bearish to neutral actually. Okay, so I would be very careful, especially keep in mind we know that crude is quite correlated with what's happening with risk. If risk really sours within the next few days and we see a continuation lower, and especially if the S&P breaks through that 2890 area, I wouldn't want to be long crude in any way. Question about Euro pound. Yes, good for reminding me, because I want to show something about that as well. Patrick says GBP construction PMI results showed a big contraction as compared to previous results. I mean, no wonder there. I mean, we've seen manufacturing indices plans, across the globe, and I see a lot of people making the stupid argument that for economies, for example, like the US, manufacturing is now something like a little bit more than 10% of the GDP, but I don't remember ever seeing manufacturing plunging and going in, in recession levels and everything else not following, like consumption, for example. So, don't listen to arguments like that to believe that very weak manufacturing numbers should be ignored because, okay, come on, I mean, what's the big deal? I mean, that's a small percentage of the US economy, for example. No, that's not the case. I mean, it is the case that it's a rather small number, but don't think that it works in an unrelated fashion. That's what I mean. Comments about TweetDeck. Okay, let's go to Euro Pound, and then we've answered that. What's my thoughts on yen crosses? Yes, we can have a look at a few of the yen crosses, but let's first have a look at what's happening here with the Euro Pound. And although I'm going to first open the daily chart, I actually want to take you then to the 4-hour chart because you will be able to see better. Okay, so here it is. Here is what I see in the Euro Pound. I see a rebound, right, from quite a key area. That's the 61.8 from that low to that high. Okay, so actually, sorry, yeah, there it is, 61.8. So a rebound from there, but how does this rebound look to you? It definitely looks corrected to me so far. Okay. So despite seeing a rebound here, I would keep an eye at the 89.50 area because I think it's, quite a high chance that we're going to get rejected and continue the downside once again. I don't see any bullish characteristics so far in this rebound, and that tells me that perhaps this pullback is not over yet. Okay, so that's what I think. I think that the Euro Pound is probably best idea to be looking for opportunities to short it for the time being until proven otherwise. Now, the question we had about yen crosses in general. I have to tell you that the vast majority of the yen crosses have really failed. So, for example, we had this nice rebound from this descending wedge in the euro yen. We're now retesting the 61.8, but it looks very heavy to me. I mean, the initial reaction we got from the 61.8 was extremely weak, and that's a bad omen. I mean, it looks to me like it wants to continue lower. If you have a look at the pound yen, let's switch to it. There it is. I was looking as a very key area. That's why we had drawn, these lines a long time ago. Like, whenever I do this, I saw on a chart that, there are two directions from a specific area. It means that I consider that to be a key area for the trend. So in this case, that proved to be the case. I mean, we got a rejection from there, and we've kept moving lower from there. So, that was the first key resistance that the pound yen was facing. And guess what? It miserably failed. Okay, so it seems to be quite heavy. And, it seems to me quite likely that we might continue lower. Now, of course, we're still a decent distance away from the lows. And I have to say that, we had a double bottom there. Its resistance might act again as support. So, pound yen doesn't look that bearish yet. I mean, there are still a couple of levels, like the 50% fib and the 50 DMA at 131.15, and then that previous resistance area that might act as support that might cause the pair to rebound again. So it's not like I'm 100% certain that it's headed to new lows. But if you have a look at other yen crosses, for example, let's go have a look at what's happening with the Aussie yen and the Kiwi yen, you'll see that, and I showed those yesterday as well. I said yesterday when we were off the lows quite a lot, I mean, we moved lower afterwards, that the Aussie yen is crafting here. I showed also the 4-hour chart that it was bear flagging, and as you see, that has already been broken, and it's well on its way and towards the lows. And the Kiwi yen, same deal, bear flag, has broken to the downside. We are very, very, very close to the lows, right? So Kiwi yen faces this descending channel support, which is quite important. So that would make it a little bit hard for somebody to pull the trigger here and look to be short, but that doesn't mean that they don't look bad. And even look at this trend line in the other side, it seems to be breaking the downside. So I would be very, very careful with the yen pairs because they look very heavy. And if they want to turn higher, they really need to start doing it now, because then it's going to be too late. I mean, the technical damage is going to be too big, and probably we're going to see accelerated losses. Okay, that's what I think about them. Gold we covered, crude we covered, gold again. Too much love for gold. We covered that. Dollar is the king. Don't expect a fall, especially about euro. It's all about market expectations. The market is expecting the worst, having to do with the Eurozone, and, in a big extent, rightfully so. But in all honesty, are the equivalent expectations of the market having to do with the US economy realistic or not? In my opinion, they're not. So at some point, when the market is going to have to reprice how beautiful in comparison the US economy looks, and it will realize that even if the outcome is that, it's looking better than the other economies, they will realize that it's not looking that much better than the other economies. I mean, in comparison, it might end up being better, but I don't think as much as the market is pricing in. that will then lead to a repricing in the exchange rates as well.
Yeah,
so,
Steve, it used to be if America had a cold, the rest of the world caught pneumonia. Now maybe it's if the rest of the world has pneumonia, at least the U.S. catches a cold.
Coach, I know that I've said it before and you've heard me say it. I know that it's extremely controversial, but personally, and I know that the vast majority of our listeners will not accept that, personally, I think that the US economy is in a worse shape than the vast majority of the developed economies.
Okay.
And proof of that is one simple factor.
Debt.
Have you looked at the budget?
Yeah.
No, forget about the debt. Have you looked at the German budget, for example? It's running a deficit of what is it? 2%. The US economy, to perform better than the rest of the world at the moment, which it is performing better, there's no question about it, but it is running an effective budget deficit of around 8 to 9%. Question: if tomorrow Angela Merkel woke up and said, Germany will run a budget deficit of 9%, which of the two economies do you believe would overperform the other?
Yeah, Germany.
Exactly. Now you understand what I mean? So we're comparing apple to oranges. We're putting down economic indices without taking into account, okay, for the US economy to produce whatever it produces at the moment as performance, what does that require? Answer: it requires a huge accumulation of debt on a yearly basis. But that's not playing a fair game. I mean, I'm not saying it's unfair, but I'm saying that if you're comparing, for example, Germany with a 2% budget deficit without performance in comparison with the US running a 9% budget deficit, and if somebody looks at the numbers and says, but they're not running a 9% deficit, I will tell you, count the numbers again. Don't look at the deficit, because unfortunately, for some stupid reason, they have like huge part of the deficit, they call it like off-budget items. So if you want to see the actual deficit, just see how much money they have to borrow every year to balance the budget again.
Anyway, there's going to be very, where do you hide? Find me a region on the globe. It's going to be global. It's going to be in different degrees, but it's not going to be great for anyone. I rest my case.
There's no question about it. There's going to be pain.
And it's time for the interview.
There's going to be pain across the board.
I actually have an interview.
Yeah, to be honest, yeah.
Yeah.
I mean,
so
we've had
and John stepped up because I wasn't going to wait till the next day for our guest to confirm. So John Davies is with us. John really supports us on Twitter, Steve. Have you noticed? He really thinks that we offer great financial insights every morning, and he promotes it. And he was very constructive miners last time we were together. And John?
And that's, by the way, that's a great thesis and a great position. If I may say one thing, Dale, because a lot of people don't realize that, keep in mind that liking miners and being long miner stocks, in essence, it also gives you like a free option, because the vast majority of the mining companies have a lot of unmined gold or silver that financially makes no sense to mine it until the price hits a specific level. Absolutely. So the market, in essence, prices out completely those until they make sense to be mined.
Mm-hmm.
So
brilliant comment.
Yeah, so that means that after a price level, immediately the market has to reprice that, they have an extra amount of gold that, they wouldn't be mining at $1,200, but now they can actually mine it and make money from that.
Yeah, it's above production costs.
That's an absolute fact. And I will stretch
John Davies, Steve Vulgaridis.
Nice to meet you.
Nice to meet you too, Steve. Thank you very much. And first, let me just say, and I've mentioned this before, both probably most importantly to people behind the scenes, but certainly on Twitter, you gentlemen, you offer a tremendous service for investors of today. and it's remarkable online. And the thing that I really like about this most, and Dale, you know, you're the only one who can really understand this. It brings together the training camaraderie that existed, you know, 25, 30 plus years ago. And that you also will have people of difference of opinion, sharing thought, not afraid to disagree, but they've all got skin in the game. And that's what really matters. And so I really urge investors, whether or not they're involved in the futures game or not, to be involved with ForexAnalytix.
Thank you, John.
Thank you very much.
Steve brought up a tremendous point, but before we mention
Are you
it,
going to share your screen, John? Do you have anything you
no,
want?
no, I like looking at your screens better anyways. It's
Okay.
better than my screen anyways.
Okay. Yeah, okay, go ahead, Steve. You can leave your screen up there, I guess. Okay.
Yeah, one of the things that Steve
coach.
brought up was a tremendous
I'll
point.
take it.
People don't quite understand that if you say, Steve mentioned in gold and the production of it, right now there's a lot of tremendous mines coming on stream in the precious metals that financially they are putting in their base assumption of a $1,500 price. And these are just coming on stream right now. In other words, they're just being opened up at this stage. And that's how confident the industry is right now. But where it really hits home, where this really hits home, is in the base metal sector. Because let me just tell you right now, there is not going to be ground broken in, say, for instance, bellwether copper at the 255 price, a new mines spoken of. Now, we all know that at least there is a strong thought that copper is in a severe deficit position in the coming years. So in essence, this present price retracement exasperates the problem going forward, right?
Yeah, I'm showing the weekly chart of copper right now.
Yeah, I mean, and it's a fascinating element, and not a lot of people really consider, because we're all looking at
Still
these,
looks vulnerable to me, especially if we get risk
it
off.
absolutely is vulnerable.
I mean,
Without
to me,
question.
John, this looks like a descending triangle. I'm almost afraid to say what it measures.
Well, you know, it's whether or not, as we all
Under
know,
$2.
we're all now hypersensitive to all economic functions. In other words, the market, and I tend to believe now, the market is highly reactionary, more reactionary than in prior years. It tends
You know,
to
John, speaking of reactions, you're a pro. What was your interpretation of what happened in the repo market and what happened in Fed funds market that went from 1% to 2%?
Well, obviously,
do you buy it? Do you buy that it's just a big tax payment by corporations?
Well, that's a great point. No, I'm actually very concerned about what's going on in the repo market. Obviously, that's it.
No one's talking about it. They brushed it under the rug. It was just
it's actually
another technical blip that the Fed easily solved with, I don't know, 60 billion a day or whatever.
It was well underneath the rug, and no one is spending enough time on the consequences. We can't say it enough. The consequences of
liquidity.
Yeah, and U.S. dollar debt, and the fact of the implications on commodities as the U.S. dollar rescinds, and obviously Fed rates, right? No one could even take a look at that. I mean, matter of fact, yesterday, I think I even posted this, and it's rather funny or illuminating in the sense that whenever we get a serious gold pullback, I tell people these are all certainly within a strategy, a guarded strategy, if you might want to call it, are opportunities. Because long term, we're looking at serious repercussions from the obviously potentially negative interest rates and a considerably falling U.S. dollar. And this is going to hit home within the commodity market. But that seems to be a emotional behavioral habit of the markets of 2019, the modern investment community, where we have these constant whipsaw actions. To whatever extent, it depends on what sector you're in, but we often have considerably whipsawing actions. Mind the whipsaw, you have to always. Now, for the investor, the retail investor, to me, and I think it was Blake who said this earlier, who's, you know, waiting for greater volatility. For most of the retail investors, and I heard a gentleman the other day very fearful of what happens in October, and I said, this is actually opportunity, and this is the you know, the birthing grounds of where you establish a sturdy portfolio, a lower basis. You can actually use this to significantly to your advantage. It does require certainly nerves of steel and hopefully a good mentor, right? But I think this is, we have to start looking at behavioral habits of the modern investment community and how for retail investors, how we can make the most of this, right?
Yeah, okay.
And I think that certainly relates to when we're going back and looking at copper. Now, naturally, there's going to be, we can look at it. I mean, I'm right now staring in those mid 240s for some support. Obviously, that is where you see that breakdown. And obviously, the numbers yesterday, manufacturing numbers were horrid, right? So yeah. It lended for that strong pullback that you also saw in some of the senior copper miners, most notably.
How about something like this? From here.
Yes, and
is that possible?
Well, I see it certainly possible, but we also had things come into the room that we had not really accounted for. In other words, we were steaming along in copper, very fine, and starting to think, where do we get that?
Until the trade war?
Yes, exactly. This is all a trade war. We were all sitting there at 330. Projects were on board. People were thinking, okay, we get 330, 350. This is a go. And then there was the trade war rumblings, and the drum started beating very strong. And certainly, economic data would later be supportive of greater problems. But the trade war, this trade war and the escalation of the trade war, you can basically put a chart on copper, and you can see how it completely collapsed, right. Including that the optimism in the first quarter, approximately March of this year, that you can see that little blip up, blip up when it went up to the approach the 290. And then it found out we're not going to get this trade war reconciliation, and it came down. So now what this then does is leads to greater problems long term into production, right? So that great economic push-pull.
Where is production break even for a lot of the copper issues you found?
Well, you're simply
350.
You're not going to get any major copper production coming on stream, or let's say being put into play at the present prices. So we are going to have an even greater deficit, because to get a copper mine on stream, you're looking at
forever.
Well, approximately 8 years. That's what people don't realize.
That's forever for me at my stage.
Well, I think we're in an agreement that we're both at that forever stage at 8 years.
Yeah.
But it's very true. People think of and you look at people who are very optimistic, let's say, of the global infrastructure developments, the role of alternative energy, which alternative energy really means base metals and more petrochemicals. I hate to put it that way, but they're all built upon base metals and petrochemicals, but those things, and obviously electrification of automobiles, those things take time in their materials. In other words, if we need greater copper, well, we might be able to get on stream by 2027 now. Right. More than likely, likely we're pouring copper out of that mine in 8 years. So this is very long-term investment. The CapEx is extraordinary, right?
So, John, you're a veteran, and you've seen many cycles. Is it ever right for you just to be out and cash as a position?
Well, no. To be quite honest, it's not necessary. I don't necessarily am out because, for instance, I just look at how I take different takes on my hedging policies, and And it might be something as simple. And I think this is a very important topic, by the way, Dale, for us to continue on, is that, for instance, we're in a period of negative interest rates. Many of us are going into those retirement years, and we may face 30 plus years of retirement where, you know, we've got negative interest. So it's all of a sudden a very complicating factor, nothing that we considered. So we're going to have to raise have a rate of return. So maybe we're looking at a dividend portfolio, and how we want to goose that dividend portfolio up might be the use of writing covered calls and doubling, trebling. I'm able to, some of my accounts, we can triple and quadruple our ROI in our dividend portfolio. So we're not necessarily out as much as we're more hedged. And this is what I tell people often. Just by being in cash doesn't mean you are safe. It means you are maybe exposed, particularly when we have, you know, we look at things on a global front. So I look at it when I have money invested in properly. That means, and for me, a proper account means I strangle risk. I strangle risk. I like to come very early to the trade, and I like to leave a lot on the table, right? In other words, leave enough on the table that I'm safely out, but then I'll look at, you know, I'll scalp out that, I'll take out the meat of the trade and leave dessert on the table.
What do you think of this chart? The megaphone.
Well, I mean, what are you looking at right now on the S&P? I mean, my concern is obviously, again, I think it was Blake who said this earlier, and I've been warning people of this, is obviously the trade, right? Is our trade and our discussions. We don't really know if there's going to be a loose cannon in this. I'm one to believe that there will be no trade war settlement, and this is going to go longer, but that's just an opinion. It's not nothing that you base a trading
I
approach.
agree with that.
You read it. In other words, we always read and react. So I believe there's a retracement coming, but in that period of time, as I've started to suggest people in August, let's start to build our cash war chest so that we have money for Q4, because this is where we're going to see a retracement. But when we enter positions, let's say we're entering on the equities front, we're entering positions in Q4 in October, and October, the first day of the month, certainly gave us a lesson. We enter it within very safe positions where we use and buy rights that are deep in the money, where we're scalping a heavy bunch of premium, so that at the end of week one, we're always going to be effectively, you know, in the green. Now, so what it means is that we really need a more tactically advanced position than just saying, I'm going to cash, I'm putting my money in the mattress because, gosh, I can't even get money at the bank anymore, right?
Right. So that's where you own an underlying equity.
Yes. Yeah.
And you sell puts and calls.
Yeah. Well, I sell calls.
You
That's
sell
right.
calls. Okay.
Yeah, I sell calls. And see, the thing that people don't realize that, you know, you can always own a stock. Like, you know, I don't know, use an example like Schlumberger, you know, which is, and some people might argue about it and have a difference of opinion. I certainly, you know, within a pipeline, but, you know, you're looking at a company trading with a 6.1 dividend yield. It's a quarterly yield. Well, there is no quarterly, pardon me, pays quarterly. There is no reason that a person can't buy the stock, own the stock, take out that dividend, and write in the money calls each week that gives them a little bit of premium. So they're chopping out. That's our scalp, right? Our scalp. Maybe you're taking yourself an extra. My goal, I'd like to take out, you know, 0.6% of a portfolio per week, because 0.6% of portfolio, my gosh, we are going to be getting ourselves well over 30%. So there's no reason a person can't buy the stock, and you can see it's well below its low, buy the stock, own the stock, take out that dividend, but always have a safety net, right, of maybe 10% below the present price if there's a retracement each week, and then just before the market closed, buy that call back and write the next week forward, so any deficit is funded by the next week and more. You're always having a positive cash flow. See, there's ways that we can do this. There's ways that we can do this to always have a relatively fully hedged portfolio that provides us regular income and allows us to participate in an upscale and in an improving market conditions, but we'll always have ourselves hedged. I don't like the idea of saying, cash means we're fully hedged. No, cash means we are in cash and exposed, right?
Exposed to currency risk of other.
Yeah, I mean, there's. Yeah, I mean, anything that happens to what can happen in cash. I mean, cash positions, particularly if we have a falling dollar. I mean, we all know what a horrible thing it is to go through, a life and spending, 30 plus years saving funds and thinking that you're going to be getting 5 to, maybe higher percent rates of return in your retirement, and finding out, my gosh, am I really going into retirement of 30 years now and having a negative cash flow, right? Getting negative interest rates. So I want to impress upon people there are definite ways that they can hedge their positions, earn extra income that are safe, and they can be confident of. But it's tactics, and I guess in some ways these are things that have been missed in this era of investing. Because I tell people, the idea is that you never want to be comfortable. In other words, you want to tend to invest, be comfortable at being uncomfortable. You want to buy into selling frenzies, right? When people are selling, this is when you want to start buying. When people are buying, you want into those, you want to sell off, right? You want to come early and leave just as early, but you always want to maintain a hedged position, whether fully hedged or partially hedged. It all depends on your risk tolerance levels, right?
Mm-hmm.
So I think it's a breathtaking time to be, involved in the markets, whether or not you're involved in futures. I mean, the futures side is just equally as exciting because we have such tremendous different economic events going on, but those all become extra opportunities for us. And again, this is one of the things that your service provides, because it provides its users, its listeners, so much intel that they can have a leg up, in my opinion, on the balance of the market.
Thanks, because John, I don't think Rod Serling could have written this script that we're living in.
Oh no, this is if I can't believe what an investment climate this is right now. And many of the things, like I know you and I will talk of the use of, for instance, in just the options market, you will see so many different opportunities present themselves, and sometimes I just wonder, why don't more people see them? We look at huge swings in the market. Who would ever imagine?
And now you have zero commissions with all the online brokers. I mean, that's got to mean something, like the death of the brokerage industry.
Yes, and it will fund
the funeral.
And what really bothers me is we're going to see investors, and I'm careful sometimes recommending positions now online, because I'll see investors who can't buy don't have the capital enough to, say, acquire board lots, going into very complicated type plays, and only half of it. And they're going in and purchasing, and they're usually not buying on fundamentals. They're buying on emotional contagion. So they're basically the herd, ready for the slaughter. So what I'm hopeful is that we have a greater mentorship program online that provides people, look, I'm a long game investor. This is my approach. My approach, my long game tactic plan started in 1983, and it's going to last long after my days. And that's what that's obviously my focus, but I'm very concerned of the investors today not realizing how many different opportunities they have available to them, how many different strategies that can be implemented to get to their long game goals, right?
Best idea for the last quarter, John.
What do you have
a lot of conviction about?
Well, I mean, one of the things that I want focus people on is, make sure you keep constantly building your war chest. My intention is, remember, I always use options in my account. So I'm a scalper, so if I can buy a stock at $19 or $20 and sell the $18 call for $2.50 on Friday, I'm probably going to be pretty happy with that, right? You know, in other words, so I'm going to look at scalping. Look for opportunities within the in the mining, the base metal sector, the precious metal sector within weakness, and also petroleum and natural gas. But within each one of these, and I want to impress upon this with anyone, always do it within a hedged position. You always have to have an exit door. You always have to have your risk defined, right?
Okay. So for people that don't know how to do what you do, what's the best way for them to get in touch with you, Jen?
I think that, boy, I can't believe you fed this to me. I think, Dale, join us on the 4th of November. No, we will talk online as much as possible. And I think I'm back on your show approximately a month from now. I'm happy I'm happy to talk more about this, right, and help people out. My intention, as we've discussed, I'm proud to say this is my 3rd time on the show, isn't to promote, say, a website or a service. I'm not interested. I'd rather just help people and give the benefits of my career, right? And that's a very.
So what should they do? Just reach out through Twitter?
Reach out for Twitter, and you know what? We can get involved in greater conversations too on ForexAnalytix if it's of interest to people, right?
Okay, so your Twitter address
is it's Renegade Style.
Renegade Style. And John, thank you so much for being with us
No,
today.
thank you, and thank you for bringing me in from the bullpen, Dale.
All right. Well, you know what? You get the save.
There you go.
Huh?
Not bad for. I thought I was a long reliever.
Yeah, you were. You were. So you went about 5 innings and only gave up a run, and you saved the game.
There you go.
As a starting pitcher. All right.
Well, as I leave, just let me remind people: markets each week, markets may go up, and markets may go down, but option premium will decay.
Yeah. In fact, you and dentists love decay.
There you go. The doctors in the
They
house.
both make you money. All right. They both make money with decay. So, all right, John. Thanks so much.
Thank you very much for having me, Dale. Have a wonderful day.
Yeah. Good luck. Okay. That's a wrap, everyone. We'll see everyone tomorrow. Tomorrow I have Alba directly from Spain, I believe. She's on the beach in Spain. So adios, everyone. I'm going to end the meeting. Don't just count your pips, count your blessings, and see everyone tomorrow. And we have NFP Friday, and I have a great guest for Friday. He's going to talk about what the Fed did 2 years ago that's starting to impact everything now. All right, everyone. Thank you, Brock. See ya. Don't just count your pips, count your blessings.